Welcome to Talk Tickers. Today we're digging into Easterly Government Properties, ticker DEA. Now this is a company built on what's probably the safest tenant in the world, the U.S. government. But the big question is, does that make it a defensive gem or just a boring stock? Let's get into it.
And that's really the core question for a real estate trust like this, isn't it? Is its super steady, predictable business model a real advantage, especially in a choppy market? Or is it just, well, unexciting?
So what did the market think? Well, it gave a pretty quiet but positive nod. The stock closed up 1.4% after the earnings call. And really, that tells you investors saw pretty much exactly what they expected. A solid, steady quarter with no drama. Let's look at the numbers that got us there.
Okay, so the main takeaway here is just quiet competence. Easterly beat on revenue, they hit their FFO targets, we'll get to what that means in a sec, and crucially, they kept their full-year guidance exactly the same. That's a big signal of confidence for the rest of the year.
The first thing that really jumps out is the top-line strength. Revenue came in at $84.2 million, which was a nice beat over Wall Street's forecast. That's actually 10.5% growth compared to last year, which, is a surprisingly strong number for a company that mostly relies on long, stable government leases.
All right, next up is Core Funds from Operations, or FFO. For a real estate company, or REIT, this is the number that matters. Just think of it as the actual cash flow their properties are generating. It grew a steady 3% year over year, which was right on the money with expectations. It just goes to show how reliable that government rent check really is.
So when you put all these key numbers together, the story is crystal clear. You've got solid growth on the top line, combined with that steady, predictable cash flow underneath. This is the exact playbook you'd expect from them, and they are absolutely nailing the execution.
So that leads to the big question. How are they pulling off this kind of stability in what's, let's be honest, still a pretty tough market for real estate? Let's break down their playbook, because it's actually pretty simple.
The CEO, Darrell Crate, he pretty much laid out the whole strategy right there. It's all about owning buildings that are indispensable. We're not talking about just any office building. We're talking about courthouses, secure federal agency headquarters, and FBI labs. These are places the government literally can't function without.
Now, this discipline didn't just happen. You have to remember, management made some tough calls earlier this year. They cut the dividend to hang on to more cash, and they did a reverse stock split. Both of those moves were about shoring up the balance sheet, really setting the foundation for the kind of stability we're seeing today.
Okay, to really get their strategy, we've got to talk about one key term: cost of capital. All it is the minimum return they need to make on a new property just to break even on their financing. And management was super clear on the call. For Easterly, that number right now is in the 8s. And believe me, that one number is the key to their entire growth formula.
And that 8 is what makes this whole thing tick. Because they know their cost is in the 8s, they can go out and look for deals with a cap rate, which is just the initial yield on a property, in the 9s. That difference creates an immediate 1.5% profit spread. It means every single new building they buy is profitable from day one. It's just a remarkably clean and disciplined way to grow.
All right, so that's the playbook. Now let's turn to the future and see how this all feeds into their guidance and what we should all be watching for next.
And here it is, the key signal to the market. Management reaffirmed their full-year guidance. By holding that line, they're basically telling everyone, yeah, the solid quarter you just saw, we expect that to continue right through the end of the year. That's confidence. So what could actually move the needle for the stock from here? I kind of see two big buckets of catalysts. You've got company-specific stuff, like making progress on that Oregon courthouse development. Then you have the macro picture. Any hint of lower interest rates would be a huge tailwind for these guys. Oh, and that big FDA repayment? That's their dry powder, the cash they'll use to go hunt for those next profitable deals.
So let's put it all together and figure out our thesis, our next call for Q3 and the rest of the year.
When you get right down to it, it really boils down to two competing stories, a bull case versus a bear case.
The bull case is pretty simple. In a crazy, uncertain world, this defensive portfolio is a safe place to be, and if rates ever get cut, that's pure upside. The bear case, though, worries that their high cost of capital, remember those 8s, is going to put a cap on just how fast they can actually grow.
So our call here at Talk Tickers is market perform. Look, the company is executing its plan perfectly, no doubt, but it feels like that stability is already baked into the stock price. For now, that high cost of capital really does act like a ceiling on their growth, which probably keeps the stock stuck in a range, at least until interest rates fall or one of those big catalysts finally hits.
So the real question heading into the next quarter is this. Can their disciplined execution alone be enough to push the stock higher? Or is Easterly going to remain a prisoner of the Fed's interest rate policy? Of course, this is not financial advice.